All right. So chapter 6 is about economic growth. Chapter 7 is about the asset market. Or the money market. So this is the first place in our model where the price level comes into play. So the price level is going to have a role to play in this in the model, and so is the Federal Reserve. All right. So there are two things out of this. So there are implications for the price level and the Federal Reserve policy. So I'm not going to go over every bit of chapter 7 here, right? But the chapter starts because some things you can get, right? What do we mean by money, right? What do we mean by money? So we're going to talk about the demand and supply of assets, and we'll get to that. Money is one type of asset. Assets are how you hold your wealth, right? So can you hear me? Can you hear me okay? I'm using the microphone on the computer, but I'm looking at the pad that I am drawing pad, but I can put on my headphone otherwise. Can you hear okay? I just need a yay or nay. Maybe you can't hear me. No, you okay? Can you hear? Here, I'll put it on. That way we'll make sure, we'll really make sure. Okay. All right, you should be able to hear me now. Yes, Calvin? Yep, all right. Yeah, this particular headset is yeah, we're good. Some different controls. So, all right. So, thank you, Aviana. Yes, thanks. All right, so money. We're talking about this is stuff we learn in two different courses, Econ 201, money and banking. All right, so the uses of money. Whoops. right? And in our particular case, we're interested in money as a medium of exchange. But it can also be used as a store of value. It's also used as a unit of account, the way we price things. So we can put the store of value because that's what we mean. That's the asset part, right? So these are the two things that sort of trading off and things in terms of how to use money or how much money we hold on to, right? So, and then there are ways that we actually measure money: M1, M2, M3, etc. M1 includes coin and currency and checkable deposits. M2 adds M1 plus savings accounts and other kind of time deposits, certificates of deposit, money market mutual funds, money market deposit accounts, things like that. The point is, these two are related to the use of money for buying things, right? So how much money you have in your checking or saving account is tied to your money machine card, for example, etc. And you could ask a question like, a credit card's money? No, they're not, because ultimately you've got to pay off your credit card balances with money. That is money, something you have from your savings or checking account or cash. So cash is included as well, right? So the Federal Reserve measures the money supply. We can also think about the uses of money in terms of demand for money, why people want to hold on to money, either to buy things or to store part of their wealth, right? So if we think about people's wealth, things that accumulated savings, for example, all right, how to hold that money, how to hold that wealth, right? Right. That's what we're talking about when we talk about assets. So assets could be monetary, money, right, or non-monetary. Okay. So non-monetary assets could be real estate, for example, houses, could be stocks and bonds, retirement accounts, it could be car collections, anything that's not money, a way to hold value, right? Right. So the question is how to hold value, right? What assets do we use? So typically we have some portfolio of assets. Why would we hold on? So monetary assets, money, M1, M2, M3, checking and savings accounts, and the like, right? That's one way we can use them as a store of value, but the fact is we can use them to buy goods and services. So there's some trade-off between, you don't put all your money, all your assets into non-monetary assets typically because they're not as liquid, right? There are different characteristics of assets, right? So liquidity matters, how easily you can turn those assets into money that you can buy other goods and services, risk, expected return, right, etc. Right. So, and you make decisions about your portfolio from your wealth, right, based on these characteristics, based on what you want to achieve, your goals, and make your choices, which can vary over time, obviously, in terms of how you hold on to your wealth in terms of monetary versus non-monetary assets, right? So we can break the world into those two bins. So why is that useful? So if we let's just do it this way. In equilibrium, the supply of non-monetary assets and the supply of monetary assets, so we'll use M here, we'll use NM here, has to equal the demand for overall demand for assets, monetary, right? Supply, either that or the prices of those assets will change if that's not the case, right? In a market where in a capitalistic economy where prices are flexible. Right, so we can rearrange this and say, well, we can bring this to the other side, subtract from both sides. We can bring this to the other side, subtract from both sides, money demand minus money supply. So what it means is if the demand for monetary assets equals the supply of monetary assets, then that's zero, right? Then this is zero. And if that's zero, this has got to be true. That means the supply of non-monetary assets has to equal the demand for non-monetary assets. All right. So in that case, if this one's in equilibrium, the other one's got to be in equilibrium. So we don't need to look at both. We just need to look at one. And different textbooks actually do this different ways, but we're just going to look at the money market, right? So all we have to do is look at the demand and supply for monetary assets, money, M1, M2, M3, checking accounts, savings accounts, cash, certificates of deposit, and the like, all right? And we can look for equilibrium there, and we'll know we're equilibrium in the asset market overall. All right, so that's the deal. So this graph is actually not in chapter 7, but it's discussed in chapter 7. So, and it's actually in section 9.3, but the wording of this is in chapter 7, right? So again, we're talking about the asset market. The other markets we have in our model: labor market, goods market, asset market. That plus the production function is our whole model. That's what we're getting to in chapter 9. All right, so we're going to talk about real money supply, real money demand, and that price level is given right now. That's the overall price level in the economy, like the consumer price index. All right. And here's the here's the real money supply. All right, it's a vertical line. It's not dependent on the interest rate because Federal Reserve controls this. But note also that if the price level changes, the real money supply for a given nominal, what the Federal Reserve controls is actually the nominal money supply, right? And so for a given nominal money supply, if the price level changes, the real money supply, that line is going to shift. That's going to come into play later. So real money demand depends on the level of real GDP. We need, the idea there is we need money in your checking and savings account in order to buy goods and services. As GDP increases, as income increases, people buy more, they generally hold on to more money in that case, and vice versa. If real GDP falls, income falls, less money demanded. Okay, why has it got this slope to it like this? As the real interest rate on non-monetary assets, R is the real interest rate on non-monetary assets. As that rises, the opportunity cost of holding on to money in your bank account goes down. In other words, it's a real return on stocks and bonds in the stock market, let's say, goes up. People tend to conserve on holdings of M1, M2, M3, their checking accounts, savings accounts, etc. Right? Because they don't get, these days, essentially get 0% return. It's still better than a negative return, but which can happen with stocks and bonds, but nonetheless. So that's the reason for the downward slope to this. Together, those determine the equilibrium real interest rate, and then this is the level of real money in the economy, right, at any point in time. All right. So the Federal Reserve can change the money supply, can change the interest rate. And by doing that, by changing the money supply, it can change the real interest rate up or down, or in this case, up, right? So that's monetary policy. That's going to come back into play, chapter 9. Okay, monetary policy. So the asset market, one of the important reasons for looking at that is to bring the Federal Reserve and the price level into the model. So that's really all we need to say about that. There's some additional discussion in that chapter about the role of money and inflation. And it is typically the case that how much money is in circulation in the economy is tied positively to inflation in the economy. So one of the goals of the Federal Reserve is to manage the money supply to keep inflation low. It's one of the what's called the twin mandates for the Federal Reserve. That is part of the Federal Reserve Act of 1913. That's when it was created, and then later updated as well. But the twin mandates are to keep the economy as close to full employment as possible and to keep inflation low. That's in their mandate. That's what the Federal Reserve is supposed to do by Congress. Right. So, but the Federal Reserve is not a separate. It's an agency, but it's not a separate branch of government. It was created with a stroke of legislative pen from Congress, and it could be done away with by Congress as well. They wouldn't do that, but they threaten periodically. Republicans threaten periodically. We'll get to that part too, actually, because generally it depends on your view about whether anybody should be intervening in the economy or not. So what they do is Congress requires the head of the Federal Reserve, the head of the Board of Governors of the Federal Reserve, to testify before the House Banking Committee and Senate Banking Committee twice a year. And that's where they can grill the, and typically do grill the Federal Reserve Chair about what's going on in the economy and Federal Reserve policy. So that's really what I want to focus on in terms of Chapter 7. If anybody has questions about that and wants me to stop on anything, now's the time to say something, or I'm going to move toward Chapter 8. Okay, so put a line across there. Actually, let's move down to another page here. Okay, Chapter 9, or Chapter 8, sorry. So Chapter 8 changes the focus to business cycles. So Chapter 8 starts out by talking about what are business cycles, and then it talks about business cycle behavior in the US economy since the 1940s, roughly. And then it ends with a preview of what's coming in Chapter 9 and how that's related to this material in Chapter 8. Okay. So let me give you the helicopter view of this. So in the 1940s, there were these guys named Burns and Mitchell. Arthur Burns, Wesley Clair Mitchell. Arthur Burns later became the head of the Federal Reserve. They're working at the National Bureau of Economic Research, and they write this. There's this book that they write that's full of data, graphs, called Measuring Business Cycles. Actually, I have a copy of that book. The reason I have a copy of that book is because that was part of what I did my dissertation on, not in the 1940s. I was not born then. But a modern look, modern at the time in the 80s, about the work that they did and looking at that with some newer techniques and newer macroeconomic models to see whether those newer macroeconomic models accounted for the business cycle facts. That's kind of the key phrase that Burns and Mitchell and then others focused on. So what Burns and Mitchell noticed when they looked at all sorts of economic data, that like before this, there really wasn't as much discussion about business cycles. 1940s is following the Great Depression is really, we also have John Maynard Keynes, the Keynesian model. We'll talk about that in particular with respect to chapter 9. And that was introduced actually in chapter 1 as well. There was a lot of work done after the Great Depression to try and explain how you could have not just a really strong depression, but how it could persist essentially for most of a decade. So most of the 1930s was spent with unemployment rates at or above double digit, or near or above double digit. All right, went up as high as around 25% at the worst of the Great Depression. But we're up to around 9, 10, 11% for most of the 1930s. That's a long time, a whole decade. So that went against the prevailing view at the time, which was more along the classical model lines that prices and wages would adjust and would bring the economy back to full employment on its own. That clearly was not happening, or not happening very quickly. And so Keynes was writing at that time as well, his famous treatise that gave a different view about how the economy worked. And if prices and wages weren't flexible, then maybe you needed active involvement either by the government, Congress, and President, or by the Federal Reserve to bring the economy back to full employment and potential GDP. So there's a lot of work done in this decade around business cycles, right? So what are these business cycle facts, right? Well, Burns and Mitchell, what they noticed is they looked at things like industrial production, production of coal, production, other kinds of things that you would be looking at, employment, non-agricultural employment, hundreds of time series actually that they had at their disposal, because we were starting to measure things at that point. And had been for some period of time, and they had started measuring things about the economy during World War II, because they had to try and keep track of things, measure things in terms of production for the war effort and production for the economy. So there was a lot more of that going on. So a lot of things kind of came together in that regard. And when they looked at all those different business cycle variables, right? What Burns and Mitchell noticed, and they had a particular way of doing this and graphing it, but what they noticed was that most economic variables, I'll get Calvin, I'll get to that your comment in a minute here. I think you asked this last time as well, what they noticed was that most economic variables tended to move together. So if industrial production was going up, we were in an expansion phase, then employment was probably going up, and consumer spending was probably going up, and production of durable goods was probably going up. Like all these things tended to move together. If you graph them together, they would all kind of tend to move together, both up and down. What they also saw in the data was that sometimes things were going up and sometimes they were coming back down, but then they would go back up again. And so there were business cycles, right? So that term was coined at that time. And those business cycles weren't like regular, you couldn't say like, well, they're 10 years long or 8 months long or this or that, but they varied in length, but they were recurring. They tended to happen after each other. And they were variable in length and depth, both. So one of the things in particular, they noticed that, like I said, most of these things in terms of their co-movement, all right? Co-movement of many economic variables. So we call that being pro-cyclical. So there's a really useful table in chapter 8, table 10. The reason I know that is because it is referring to that in the homework that students in course right now just got done with last week, where they're looking at both timing and the cyclical nature, right? So some things lag or lead. We're not going to spend that. That's the timing aspect of it. I'm not going to spend as much. That's not as critical for us right now. It is for forecasting and that sort of thing. Because if you see, for example, consumer confidence going up, that tends to be a leading indicator, tends to go up before actual spending goes up by consumers in the economy. And so if that's generally true and holds regularly, then you can use that in a model, in a forecasting model, econometric model, to try and predict what's going to happen to consumer spending based on consumer confidence, for example. But this pro-cyclical part matters, right? Most economic variables are pro-cyclical. Unemployment rate is counter-cyclical. You know, when the economy is doing well, things are generally going up. The unemployment rate is going down. That's what it means to be counter-cyclical. So in this table, it's got, I don't know, 10, 20 different economic variables, and whether they're pro-cyclical, whether the variables pro-cyclical, counter-cyclical, acyclical, and then also in terms of timing, leading, lagging, or what we'll call coincident, meaning it kind of goes along pretty much right with the cycle. Okay. So why is all that important? Macro models, good macro models, need to explain the business cycle facts. That's true about any science. The theory, the models have to explain real world behavior. Otherwise, they're not good models. And we have to, or we model, and if something happens where they are for some period of time, and then something happens where what's going on in the world is not something that was predicted by the models, then you might need to change or tweak your model, all right, to make it better fit the facts. So that is important. That's important takeaway from chapter 8. What are the business cycle facts? Well, in particular, most of the economic variables, and they actually show the graphs. They come from the Federal Reserve Economic Data, FRED, which is maintained by the St. Louis Fed. And we could bring those up, and maybe we will next time. And the St. Louis Fed has thousands of time series of economic data that one can look at and download, etc. It's a great tool. So right now, the students in my class have a dashboard they have to make at the FRED site. You can do that; it's free. And so, if any of you are interested in that, I can give you information about that. It's simple and it's easy. And they'll use it in a what's called a macroeconomic briefing report that they will have due at the end of the semester, explaining recent behavior in the US economy and then making a prediction of where it's going to go over the next 6 months based on our economic models and the current economic conditions. And they'll use that data. All right, so whether you're a Keynesian economist or a classical economist, or believe, actually that is one way to think about it. What you believe about whether wages and prices adjust quickly has implications for how our models work, and that has implications for whether the models are good at explaining the business cycle facts. So we kind of have to get into the model to explain some of these things. But chapter 8 is about what data the models have to be able to explain. Right? That's really what that chapter is about. That's really what macroeconomics is about. The models have to be able to explain the real world behavior. All right, so Calvin's asked questions. Is there a long run growth effect caused by a persistent output gap? Well, generally there isn't. Well, I mean, there could be, but generally they aren't. The output gaps aren't persistent, especially since the 1940s. It's not that there aren't output gaps, but they're not generally persistent like we had in terms of the Great Depression, where we were below potential GDP for the better part of a decade. Yes, in that case, yes, skills, people are unemployed, skills deteriorate, factories are idled, not working at capacity, et cetera. So is there some long run growth effect from that? Yeah, potentially. And if people aren't going to school and whatnot, but that hasn't been as big an issue. We'll get to that, why that is, but it hasn't been as big an issue since the 1940s, roughly, partly because of Keynesian economics, Keynesian models, and the role of fiscal and monetary policy aimed at closing those output gaps. So yes, yes is the answer to that question, which is one of the reasons why policymakers work to close those output gaps. So, sorry, I'm maybe crunchy here. It's part of the reason for, in the current situation, current period, part of the reason for stimulus checks, right, is to get people spending, to get people working again, etc. Right? Because, yeah, people are going to lose. People lose skills they may have been gaining and had while they were working. If it's short period of time, probably not. But there's interesting. Is an area where PhD economists, where you go and get a PhD. There's an area where that's a question that actually you could be researching. And people do it in smaller chunks typically. But let me give you an example. So during the expansion since the Great Recession, 2008, 2009, there was a steady reduction in the unemployment rate and a steady reduction in the output gap between, we were in a recession, 2008, 2009. It's pretty severe. Started coming back out of that relatively quickly, but well, we started coming back relatively quickly, but the process was slow in getting back to full employment. But by certainly by 2016 or so, we were getting pretty close to full employment. Certainly by 2017 and 2018, we were at full employment. So one of the things, for example, that Donald Trump ran on, one of the claims that he, one of the points he would make while he was running for re-election was that prior to the pandemic hitting, that the Black unemployment rate was the lowest it had been in 50 years. Well, it's true. And the argument there, and part of the reason for that was because that Congress passed significant income tax cuts that we are all still benefiting from, right? We have lower taxes taken out, fewer taxes taken out of our paychecks every week, every month, whatever, because of the tax law changes that were made at the end of 2018, very end of 2018, and went into effect at the beginning of 2019. At that point, the economy, the debate was like, we're already at full employment. Why are we doing a tax cut? Some economists would say that because that's just going to push us beyond full employment, which tends to raise inflation. We'll be able to see that in our model, right? But that is generally the case. So unemployment rates are down to, I don't know, 3.5%, something like that, 3.6%. I don't remember exactly, but below 4%. And we normally think about 4% roughly as being full employment. There's no hard and fast rule about that. People like we don't. It may vary. It's an estimate, right? We'll try and estimate what that might be. Generally, the way they think about full employment is level of unemployment beyond which, if you go beyond which, or beyond which inflation starts to increase. Well, we don't really see that. So that actually is a little bit of a conundrum for economists, or has been in the last 5 years, a little bit, but because maybe the model isn't predicting what happens in the economy as well. Again, to get back to this point about good macro models need to explain the business cycle facts. So the unemployment rate was really low, and it was really low, relatively or historically low for African Americans, right? And so that was one of the things that he touted during his campaign, and was one of the reasons why there were a significant number of not like overwhelming majority, but a significant number of African Americans voted for Trump, right? Partly exactly for that reason, because of the economic opportunities that came about because of to bring back to the question here about output gaps. Are there long-run impacts of that? Because of the economy being at full employment, providing job opportunities, sometimes for people who may have been marginalized, right? So with those job opportunities, right, a really humming economy, with those job opportunities, people gain skills that have long-run effects on the economy. And so when the coronavirus came along and really knocked that all out, the question that remains to be seen is, as the economy starts to open up over the next year here, what's going to happen in terms of the people who were employed with those really low unemployment rates, and may have started to build up some skills that were valuable for employment. What will be the outcome in the labor market for them over the next year? So yes, short-term things can have long-term impacts, and is one of the reasons why economists generally want to have the economy operating close to full employment, right? So the difference is classical and Keynesian economists. Classicals would say, well, yeah, the economy is going to go back toward full employment on its own. Don't get involved. Keynesian economists say, like, no, we can be stuck away from full employment for a long time. Therefore, the government or the Federal Reserve or both need to be involved in trying to push the economy back to full employment. Okay. All right. So at the end of chapter 8, we get at exactly the issues and questions I was just talking about. At the end of chapter 8, there's a discussion about aggregate demand and aggregate supply. Something that was actually discussed at the beginning of the book in chapter 1. So here's the central idea. And then we're going to move into talking about chapter 9, which includes this, but also some other things. So the model that you learned about in Principles of Macroeconomics, Econ 201, here, if you were here, took the Principles of Macro here, but in macro Principles of Macro course anywhere, you'd have aggregate demand, long-run aggregate supply, and these are supposed to be straight lines, short-run aggregate supply. All right, price level and real GDP on the axes. Why? All right. So the place where all the lines cross, label it A, it's called general equilibrium. It's general because it's for all the markets. So all markets are in equilibrium at this point. In terms of the graph, all lines in the graph intersect at one point. So there's only one place on this graph where that's true, and that's at point A. So aggregate demand, this is what chapter 9 is about, has to do with IS and LM. IS, the IS curve, has to do with desired investment and desired saving. That's the goods market. That's chapter 4. So we learned about chapter 4. About the place that you left off in the course last semester. LM, liquidity and money. So money demand, money supply. The way you can remember LM has to do with that is just the M part there, right? Think about money. That's the asset market. That's the one we were just talking about. So IS and LM underlie aggregate demand. Aggregate demand represents equilibrium in the goods market and the asset market. Every point on this aggregate demand curve is an equilibrium point in both of those markets for different levels of real GDP. So the long-run aggregate supply curve represents labor market, labor demand, labor supply. And production function. That's chapter 3. Goods market, chapter 4. Asset market, chapter 7. Everything comes together here. Right? Chapter 1 is an introductory chapter. Chapter 2 is how do we measure the economy, things like real GDP, the price level, what do those things mean? Right? So how do we measure what's going on? Chapter 3 was about labor market and production function. 4 is about the goods market. And chapter 5 was international version, extension, open economy version of the goods market. Chapter 6 is about economic growth. It's about what causes that long-run supply curve to shift over time, essentially. Chapter 7 is about the asset market. Chapter 8 is business cycles. What are they? What does that mean? And chapter 9 is putting our model to work to explain business cycle behavior. That's the course. Okay. So here's the deal. And at the end of chapter 8, they talk about this. Well, let me also point out the goods market and asset market. This has to do with spending. All right, so aggregate demand has to do with spending in the economy. Lower aggregate supply has to do with production. Demand and supply. The short-run aggregate supply curve really just measures the price level. Long-run aggregate supply curve represents potential real GDP, right? Full employment level of GDP. So if the labor market's in equilibrium, we have full employment, we use that level of employment in the production function that tells us how much output we get. That's what that is. So it's a marker. The long-run aggregate supply curve is generally a marker, and we're going to ask, well, where are we relative to that marker? All right, where are we relative to that marker? So I'll change colors here. So let's say that there's an increase in aggregate demand, either because of a shift in IS or LM, either because there's something going on in the goods market or something that's going on in the asset market. All right. So in the goods market, right, the other part of saving is desired consumption, desired investment. National saving is also related to government spending. So changes in IS, changes in air demand have to do with changes in spending. The asset market has to do with the Federal Reserve, monetary policy, and so that affects spending as well. So aggregate demand has to do with spending. This is what we're likely to see over the next 6-9 months in the US economy, right? There's a lot of pent up saving by consumers, by households. Things haven't been open. People haven't been able to go on vacation, go to restaurants, go to shows, etc. So a lot of saving that's built up. As things start to open up, there's going to be, the prediction is there's going to be significant pent up demand that is going to get translated into increased spending. So probably aggregate demand is going to shift to the right. We're not starting actually at full employment. We're below full employment, so that's okay. But here's a general point. In the short run, if prices are not flexible, if prices are sticky, changes in aggregate demand lead to changes in actual GDP. All right, so the economy moves from, let's say, A to B. At that point, aggregate demand, all right, on the aggregate demand curve is greater than aggregate supply, this vertical aggregate supply curve, all right? There's excess demand, there are shortages in the economy overall. That tends to put upward pressure on the price level. And so this short-run aggregate supply curve starts to shift up. When does it stop shifting? When does the price stop going up? When all three lines are back in equilibrium in one place. So what's the basic upshot here? Is that there are the theory suggests that there are mechanisms in place in the economy, right, such that if the economy is out of equilibrium, if all three curves are not intersecting at the same place, then the price level will adjust to bring about general equilibrium in the economy. All right, that is the theory underlying macroeconomics. The question is, how long does this take? So if you believe that that's a fast process, that's the classical model. or classical version of the model. If you think it's not fast, that's the Keynesian version. Looks like Keynesian, but it's Keynes, John Maynard Keynes in the UK, right? In England. John Maynard Keynes, Keynesian economics. So Keynes was writing back in the mid-1940s, early and mid-1940s. He's just experienced a decade-long recession with unemployment rates near double digits, sometimes significantly higher than just double digits. He's seeing that prices were not adjusting to bring us back to full employment. In that case, it was the opposite, right? Spending had gone down. The economy was in a recession. Let's call it B prime. And the actual level, we'll call it Y1, we'll call that Y0. The actual level of GDP was below potential GDP, right? This is this thing called the GDP gap. So a gap had opened up, unemployment rates were high, people were in food lines, soup kitchens, etc. Right? So the economy's here. What the classical economists say, well, the price level is going to adjust. In that case, it would adjust downward, and we'd go back, right? We'd go to, let's call it C prime. So reductions in aggregate demand lead to lower prices, bring us back to full employment. Increase in aggregate demand lead to higher prices, bring us back to full employment. This wasn't happening in the real world. The unemployment was persisting. We weren't going back to full employment, or at least not very fast. So he came up with the idea, like, we can get stuck here at a point like B for a long time. Right? So if prices don't adjust quickly, that's the reason for that short run aggregate supply curve, that horizontal line. If prices don't adjust, then the economy adjusts and firms respond by changing production levels, not prices. Classical economists would say, when there's an increase in aggregate demand, that prices adjust quickly, that you go up there really fast. You don't sit out here at B, or in this case down here, you go down to here. You don't sit out at B or B prime. In that case, right, firms don't respond by adjusting output. They respond by adjusting their prices. Right. So in reality, there's some of both. That's why we still have two models that we talk about, or two versions of the model that we talk about. Reality is somewhere in between these two. But there are interesting implications of this. So let's think about the business cycle facts stuff, right? The way that business cycles happen, right? They're two key pieces of explaining business cycle behavior. So the first thing is there's some shock to the economy. There's something that throws the economy out of equilibrium, out of general equilibrium. In this case, it was a big increase in consumer spending, or big reduction in consumer spending, right? Let's say. And then how does the economy respond? All right. That's the deal. So and how it responds will depend on whether prices and wages are flexible or whether they're sticky. All right. And then the next question is, should we do anything? Policymakers, Congress, President, Federal Reserve. It depends whether you think prices adjust quickly or not. If the answer is yes, then that's what macroeconomic policy is about. That's what the current infrastructure bill legislation process is about. That's what the stimulus checks were about. That's what the Federal Reserve keeping interest rates near zero is about. So the answer to that question is yes, in that case. So this picture in a nutshell is getting at the basic idea about business cycle behavior and modeling that. So in this case, let's say there's an increase, to go back to this, there's an increase in consumer spending. So consumption is up, real GDP is up. In the Keynesian model, the assumption is that firms respond by producing more, they need more workers, employment is up. Unemployment rate is down, it's countercyclical, right? So all those things are consistent with business cycle facts, right? Real GDP is going up, employment's going up, employment's pro-cyclical then, all right, according to the model. Consumer spending is up, right? That's pro-cyclical because real GDP is going up. If we use real GDP as kind of the measure of the overall economy. Burns and Mitchell were using industrial production, but they actually were looking at all variables kind of moving together, except for the unemployment rate going the other direction. But the problem for the Keynesian model, right, is that typically prices are, in what's in that table 10 in chapter 8, prices tend to be pro-cyclical as well. They tend to go up when the economy is going up, but here the price levels are staying the same. So Keynesian model has some explaining to do with that. Okay, and there's some other things that that don't quite match up with business cycle facts either. For example, to get more workers, if you're going out along the production function, hiring more workers, they're diminishing returns, so the marginal product of labor is getting smaller. The productivity is getting lower as you hire more workers. So it's productivity in that case is counter cyclical, but in reality, in the real world data, productivity tends to be more pro-cyclical. So the Keynesian model has a harder time explaining that business cycle fact. We'll talk about on the other hand, I should say, right, for classical economists that believe that changes in aggregate demand don't have employment effects or output effects, they have just price effects. Well, they can explain the higher prices coming about from aggregate demand, but they can't explain the behavior of real GDP changing because you're just moving up this long run aggregate supply curve. So for classical economists, the only way you get business cycles, the only way you get output to be changing, going up and down over time, is if the long run aggregate supply curve is moving. In other words, there need to be supply shocks in the economy. And so classical economists would say that supply shocks are what need to dominate to create business cycles. What are supply shocks? Well, changes in technology, but also coronavirus, for example, right? Well, yeah, that probably had some movement to the left of the productive capacity of the economy over the last year. As things shut down, logistics log jams, inability to get parts, all sorts of things. Also, oil price increases in the 1970s were a big deal. And the Keynesian model couldn't explain what was happening in the economy in the 1970s because of those supply side shocks. So classical model generally does a better job with supply side shocks. The Keynesian model typically does a better job with demand side shocks. So then the question becomes, well, which kinds of shocks tend to dominate in the real world over the last 100 years or last 80 years, since the 1940s, let's say, 75 to 80 years. And the reality is it's both. So we need Keynesian classical kinds of models too. There's not one unified model that can explain everything. That's kind of the holy grail. That's where some economists work in that space to try and to create one unified macro model that can bring both of these together. We can talk about this in terms of a single model, ISLMFE, aggregate demand, aggregate supply, but we need to make certain assumptions and different assumptions. And that will always be the case, probably, actually. So we'll still hear about Keynesians, classicals, probably for a long time. Let me show you something in a little different way related to this. So if this is the real world, and this is time. This is calendar time. So this is like today, 2021. Let's say this is 1940, and this is real GDP over time. All right, and I could actually pull this up with a FRED graph, Federal Reserve Economic Data from the St. Louis Fed. We could pull that up easily, but we can just draw it to get the basic idea here, and we could plot the points, right, for each year for real GDP 1940, 41, blah blah blah, right, all the way up, and kind of do that each year, and etc. Right, and we would have something that looks like that. Not quite that regular like that, right? But those are the business cycles, right? That's what we see. There are times when real GDP is going up. Those are expansions, all right? All right, if we kind of delineate these periods, there'd be a business cycle expansion, recession, expansion, recession, expansion, right? These periods in here, and then here's a recession, right? So these periods in here are periods where real GDP is going down. We call those recessions. The other parts would be expansions. We can also just kind of put a general line through this all, kind of showing the general trend over time. So generally, so the purple is right, actual GDP, actual real GDP. The red or orange, I guess, is potential GDP. Think about that as potential GDP, real GDP. So chapter 6 is about explaining that trend and what causes changes in the slope of that trend. How fast is it increasing or not? Okay. Chapter 9 right? Chapter 9 has to do with explaining these deviations away from the long run trend, right? Business cycles. So at any point in time, right, the economy, the actual GDP, right, which we can measure, right, we measure over here, right? So there's the actual level at a point in time, right there. The trend, potential GDP in that case, at that point in time, right, measured in calendar time down here, right? There's the potential level, and there's that GDP gap. So it's another way to show it with real world data. So what the macroeconomic models need to explain is why are we away from our long run trend? This is like the long run error supply curve, the FE curve in chapter 9. Why are we sometimes away from that? Why are we sometimes above it? But notice that it tends to come back toward that trend over time. All right, that's the idea. So chapter 6 is about long run growth. Chapter 9 is about business cycles. So the graph of real GDP, and sometimes I typically start the course the very first day actually of intermediate macroeconomics by bringing in a graph of real GDP from the FRED data, actual real GDP data, and say, what are the two things you notice about that? Well, it's going up. That's the trend. But it doesn't always go up. Sometimes it goes down. Those are business cycles. That's the whole course. The goal of macroeconomic policy is to try and reduce, in particular, these recessions, is to reduce the gaps, right? To try and keep the economy as close to full employment as possible, as full employment as we can. So the question is, because if you get too far above potential GDP, typically you see inflation. If it's below, you've got unemployment. And so macroeconomic policy can help bring us back to full employment, back to potential real GDP, either through the Federal Reserve or through Congress and the president. Right. So chapter 9 is about using our models to explain that. So I'll just kind of start to outline this. We've got about 10 minutes or so left. So let me just kind of lay out the general framework here. The models that we have in chapter 9, in one case has the real interest rate on the vertical axis, real GDP on the horizontal axis. This is IS and LM. We mentioned that before. L and M, this is the asset market. So that's underneath here. The IS is the goods market. Every point on the IS is a place where I equals S, equilibrium in the asset market. And every point on the LM curve is a place where money demand, liquidity, the demand for liquidity, L, liquidity, equals the money supply for different levels of real GDP, right? That's how we draw the graphs. So I'm not going to go into detail about that. That's what the videos in chapter 9 are about. There are a number of videos there. So you can look at those. All right. I don't need to recreate those here during our time here. And then the full employment line, which is again is exactly the same as the long-run aggregate supply curve. That's potential real GDP. And that represents the labor market, equilibrium in the labor market, and the production function, bringing those two together, production function. So that's our whole model, right? Asset market, goods market, labor market, production function. That's the whole deal. So here's the point where all the markets are in equilibrium, general equilibrium. Over here in the space that we were just looking at, that you get a tease about in the end of chapter 8. It's aggregate demand, short-run aggregate supply, and long-run aggregate supply. Right? These two are exactly the same thing. This one just has price level on the axis. This one has the real interest rate on the axis. So this A corresponds to that A. So IS and LM together become aggregate demand. Right? Short-run aggregate supply is just marking the price level. So we could even take that out if we wanted to. So we've gone from 1, 2, 3 curves. There are 3 here, but really IS and LM together, this is IS, LM plus, no, so, sorry. This is IS and LM together. No, never mind that. All right, in one curve. We brought those two together in one. IS curve has to do with decisions about national saving, has to do with consumption, investment, government spending, right? desired investment, desired saving, which means the opposite of consumption. Government spending affects national saving, right, in the goods market. LM curve has to do with the price level and Federal Reserve policy, changing the money supply. The FE curve has to do with changes in production function, so changes in technology, as well as changes in labor supply, labor force participation rate, immigration, etc. Right? So the deal is, here's the question, right? This is the starting point, right? If we were underneath all of this, all right, just to be really clear, the full model, all right, has labor demand, labor supply, the real wage, employment, real GDP, the production function. These two together, right, determine the level of employment, full employment, employment. Take that up to the production function. That's how you get potential GDP. That is in the diagram up here. Okay. That's where that comes from. So that goes there. So A, all these A's are the same, right? They can't be inconsistent because the model, these are just the aggregation of all those of the other models, right? So we also have the goods market. So that's where the equilibrium real interest rate is. There's the level of investment and saving. That's where we start in the general equilibrium as well. That's where the IS curve comes from. And then we have the asset market with real money demand and real money supply. That's the real interest rate as well. And the level of real money, all right, demand and supply. And that's point A as well. So our whole model actually all together, okay. Let's see if I can, I don't think I can, yes I can. I'm using a pen and I'm using my mouse here, so. Here we go. There is our full model, right there. So the name of the game, and this is where we'll end for today, and we'll just spend all our time on chapter 9 next time. And I encourage you to look at the videos for chapter 9 that are in Blackboard for that. All right. The name of the game is to say, okay, something happens in the economy. There's some shock. Coronavirus, for example, right? Or there's some policy, could be a policy shock, right? Some change that knocks us out of general equilibrium. How do all the markets respond? So the name of the game, and what students in the course this semester have to do tonight on the exam, is use these models, right? All of these, and say, and trace through, right? That tracing through is that part, right? In what happens in each case, what happens in all the models. So I'll give you this as something to think about. How would you model what happened in the economy due to the coronavirus pandemic? And you can think about that for next Tuesday. How would that look in in each one of these markets. There will be, I'll tell you this, there's at least one shift in all of these all these curves and all these graphs, I mean, right? And you should be able to trace that through. So chapter 9 actually has examples of different kinds of things and how that would trace through in the economy, right? So the top part up here, right, those air demand, air supply, ISL, MFE, is the aggregation of all of these. So you could start there, right, and work it through. But then what does it mean for those what's happening in the underlying markets, in the goods market? So at the end of the day, we should be able to say something about what happens in the economy to the real interest rate, to level of real GDP, to the level of employment, to the real wage, to the level of investment, saving, and consumption. We should be able to say what happens, and then we should be able to say, does that match up with what we see in the actual economy? Okay. So this is what economists do. This is literally, it's a more sophisticated version of this model. That is what economists use to try and predict and forecast, and then to evaluate policy that might address the issues that brought about by the shock. So I'm going to leave you with that. I've got to head out, and we will focus for our last session next week on chapter 9. Okay. So I will see you then. Any questions that you have before I sign off here? Okay. And I'll have the video available to this as well if you want to go back and look at it at some point. But all right. We'll see you next Tuesday. So I will stop sharing and I'll see you then.